Hello traders, welcome to FreeFX. Today we've got a lot to talk about. It's the 4th of November. Welcome to my video. I'm going to just start with the SPX chart. As you can see, quite an interesting situation today because we have the best of both worlds. We've got two outcomes to the non-farm payrolls. We have the non-farm payrolls before the US Open is looking like this. Okay, so we've got participation rate, and we've got the actual headline figure, if you like. So non-farm payrolls for October. The consensus was 200,000 here, and the previous was 315. So the current print 261 is actually lower than the previous, and it's higher than the consensus. I heard somebody say that the US government spokesperson for, I think it's sort of the spokesperson for Home Affairs, if you like, said that we were going to see 150,000 jobs for the US coming out. So even sort of setting expectations lower than 200,000. But the important thing is actually as well is that the unemployment rate has ticked up from 3.5. It was expected 3.6, so it was higher, but by a very small margin. We can also go into looking at the private non-farm payrolls. That was 319 and is now 233, so that's dropped as well. What if we clicked on here and found out more information? It says private household employees, non-profit organizations, and also assisting individuals that are excluded from the calculation of private non-farm payrolls. This means obviously that overall there's been a cooling down of the jobs in October, and this can be interpreted in two different ways. So if we go back to this and we look at what happened sort of in the day and sort of had a look at the hourly, so you can see that we had quite a strong response to the data coming out. So we had a very, very big wick. You can see here the wick actually extended all the way down to here, sort of around 3,700. And the top of the wick, well, if you look at the high here, it will tell you is 3,767. Okay, so just about here. So a very long wick, came out as a doji pretty much at some point, and then that was it. So we're heading into the US Open. It's 13:51, so it's 1:51, heading towards 2 p.m. This is the 1 o'clock candle. We're getting a big sort of negative push just now. This is just happening as we speak. We come to the end of that hourly candle, and this is kind of what we're seeing. So the 12 o'clock candle looked like this, quite a limit. And then we started seeing an upward push, see that long wick there, and that's sort of being rejected. So what's being rejected essentially is this 3,800 level, around about here. What's interesting about this as well is that the conversation really is all around the Fed, because what we have essentially is, you can see we are at this sort of level, just under 3,900 there. So that was rejected obviously since the start of the week, and then we had the Fed rate decision, big push down. The 3,900 level, as I said before, represents a strong level, and we had lots of sort of confluence of things there, and also we had a divergence for about a week on the CCI, so price was rising, and so this divergence usually on the daily is significant, and we saw that for example back in August. I was sort of expecting that to happen. It did happen, and then so what happens now is kind of tricky because we got to the zero neutral level on a CCI. And the other thing that's happening about this sort of lack of direction is that if we look at the VIX, and that's the conversation we need to have, the VIX has plummeted. So we're at 24, just under 25. And, if we look at levels going past this last few weeks, when we got to those lows, we were seeing the so-called bear market rally in the summer. We were sort of down here to the 24s, okay? And that is quite worrying if you think about the conditions that why is this worrying? If you think about equities rising per se, it's not a thing that should concern us. But if you think about what the Fed is saying, the Fed is essentially trying to cool down speculative growth, because that kind of goes contra what they're trying to achieve. So they're not happy about this sort of ignoring conditions and things being pushed higher and the VIX being pushed lower. But not happy means that they give signals through press conferences and their actual hikes and actions as to where they want things to go. So they want the inflation to cool. They don't want this to continue, and for that to happen, everybody needs to kind of in essence, sort of speculative enthusiasm needs to be cooled down. Now, seemingly, if you look at sort of the Fed rate decisions, every time there's a lack of, like we've seen here through going into this rate decision on the 2nd of November, we've had a sort of push higher. So it seems that recently markets, speculation is kind of against the Fed, happening really between Fed meetings and when there is a blackout period of a week. There are no speeches from Federal Reserve members, board members, and then you have the sort of push, which is sort of unfettered, really. And then Federal Reserve steps in, announcement comes, press conference, things are kind of back to reality, pushed down, and now we're back to the sort of lack of progress in a sort of what should be a continuation of a downtrend, which is clearly been the theme of 2022, and there shouldn't be any doubt as to where we should go, which is much lower. The 16th of June low is still in place, this green line here. We touched on it and we sort of got close to it, and unfortunately that wasn't to be. We're still kind of loitering above it. So until we break that, essentially that is a cycle low, and we can say that we've gone below it already, so that's the bottom in. I don't believe that to be the case. I'm not the only one saying that. The other thing is that clearly the conversation now is in terms of response to this data. So the narrative at the moment seems to kind of float between or sort of sway between two aspects. One is the job positive and one is the job negative. So the job positive means that the economy is holding up in the US. The Federal Reserve is sort of making things more expensive because those rates get passed down to consumers. Strangely enough, they're not passed down for savings, but they're passed down on things like home buying, mortgages, etc. So and the cost of living. But unfortunately, they're not passed down to savings. So people are squeezed because the money they put away is not really, there's no reward for it, and the retail banks are not giving you high interest rates for your cash. They don't want your cash, so they're not attractive savers, and savers are trying to sort of get by with sort of either keeping cash themselves or spending it, which has been a theme of QE, really getting people to spend and pushing inflation higher. So now that we've got higher inflation that people shouldn't spend, we should surely reward them with higher interest rates for their savings. Instead, we're getting them to push themselves into risky financial assets like the crypto bubble we see during the lockdown. But that's a different consideration. But the point is that if you've got a higher job growth, in spite of everything, in spite of a higher cost of living, etc., and the Fed keeps tightening and hiking rates, what that means is that a higher print on the non-farm payrolls, essentially saying to everybody, the Fed isn't going to slow down. It has no reason to, because unemployment is still low. Open bracket on that is that there's a lagging period, and the discussion on that is how long before the effects of rate hikes are going to be felt down everything from Main Street to Wall Street to everything. So clearly, it's through the year we're working through this. Inflation is kind of still high, kind of coming down a little bit, still high. So it clearly is an issue, and clearly the Fed will continue, and clearly maybe the job market will continue to grow, but there have been recessionary signals, so it's not quite. So the other camp says that jobs, basically job numbers coming down, like we've seen here from the previous to the current, is essentially essentially also Fed positive, so that there's no difference, because that means that the Fed doesn't want to slow down even if the jobs are coming down. But also the other thing is not so much about the Fed. This is a different consideration. This is a recession fear. It's a recession signal, meaning that the real economy, so the productivity is slowing down, which means that there'll be less people, there'll be more vacancies, so the unemployment rate will start coming up. Overall, certain sectors might hold up better. Services, because it's the strongest, the largest sector in the US. But services is also sometimes a very fleeting job market, made of insecurity, insecure jobs, very short-term positions. If you think of a cafe, obviously that's a typical thing. It's not a job for life, so to speak. So, but regardless, that would be obviously a case of looking at slowing down of the economy as a recession signal, and that signals sort of, let's call it a bear market, but that signals further depreciation of assets that rely on growth. Because companies like Google, Apple, they're not just they don't live in space yet, in spite of ambitions by metaverse, etc. But they or Tesla, but they actually live in the real world. They need consumers to spend. For that, you need people to have jobs, so that pay enough for that kind of spending. So altogether, I think both camps are essentially equity negative, because or index negative, because they both you got either the Fed squeeze or the recession squeeze. There's no kind of happy story. The Fed squeeze means it's more expensive to hold things, to get liquidity, to the kind of money supply is taken out, therefore the safety net is taken out, it gets more expensive, etc. The other one is, less growth, things deteriorate, and that has an implication for financial markets as well. So I think there is no silver lining for this to continue higher to any significant degree. Sure, we can have a little rally. We've had one here. But ultimately it wasn't as long-lived as this one. It was capped, and we're still where we are. Technically, I've mentioned this. We also have something like the 1 week, very significant because we're below the basis and below the 21 moving average now. We've got a bit more room to go until here. The bands have nicely expanded. We bounced off the CCI neutral level. We've got a way to go there. So on the weekly makes sense, very bearish looking there. Downtrend continues. There's no change. Just out of curiosity, I'll show you this because it came really clear to me yesterday that on the monthly we sort of bottomed out here on the what is -131, which is a level that we reached back in 2016, and we came close to it in 2020, the pandemic crash, and also down here. We sort of dipped and curved around this level. So the monthly seems to suggest that there's a bottom there. But then if you look at these three, and you look at these three, what you end up seeing is that for June, July, we had two equal candles kind of cancelling each other out. And then you had August, which is kind of halfway through. And then you had September, October, almost equal. And you got this sort of half of the previous month, red candle in November. So if we looked at December like September, the pattern of three candles would be that the next one would head lower and surpass the lows that we currently have here around 3,600, and that would take us to maybe 3,400, something like that. That could be the end of the year, which might be what it is, or it might suddenly plunge lower. We don't know. And just sort of for levels, because I mentioned that previously we had 3980 on the options heat map here. 3980 and 3990 were very, very strong levels for buying, essentially, for longs. And if we look at this 3980, 3990, we did have these sort of strong levels of buying. but there's not been any change, so they're sort of sitting there. There's been a contraction of buying at 3880, but 3860 and 3850, we've had percentage change. 19,734, 16,138, very strong buying at 3850, 3860. So 3850 and 3860, if we go back to our daily, will take us exactly 3850, 3860, would take us to here, 3850, 3860, here. So just the top basically of the where we were on the day that the Fed made its announcement this week, so about here, okay, which was kind of this top. So there's a concentration of buys here. Let's kind of actually mark it because it'd be nice to see that visually. 3855, let's go to 3855, so that's kind of in between. So the concentration of here of buys, and then we've got going back to here. If I go, so not much happening above that in terms of change, but below that, if we go back to the previous, let's give it a second, let's just load that up. Okay, so 380s, we've seen that, and then there's not much else. I mean, the puts here at 3700 really just diminished quite a bit. I mentioned I think it was 3, let me go back, 3, 4, get back further down. Yeah, 3,400 was quite a strong kind of selling area. Indeed, all this sort of 3,430, 3,400, 9,000 increase, 850, 3,400. So we're still around these levels, 3,450, 3,400, which would take us exactly, it would take us here, 3,400, 3,450. Let's do 3,450, okay, just for a here basically. So if we just move that along about here, so that's kind of where we're at. So if you look at the June low, 16th of June, it's kind of in between these two levels. As I mentioned in a previous video, when we got to these levels and below and then higher, we were essentially in a little area, a boxed area. This is slightly wider, but essentially it's basically like enclosing that level, these two, so straddling this level. You've got the big increases in, or strong puts here and strong calls here. But we are sort of below that, so there's an expectation to go higher from that level and lower from this level. Now lower, it doesn't mean to say that we want to go lower, it just means that should this get to this level, people will claim their orders here and obviously get some money for it. But it also means there's a concentration of, sell orders essentially here, and that means that we could essentially continue higher if these get taken out and then there's a lack of sellers, or more get built on that and we continue lower. Now, just kind of looking at the picture here for the monthly, just to give you a sense of where we are. And I'm going to take back some of these lines because I took out a few. I think it was this one, or maybe no. These don't need these ones. Fine. It was this one that I haven't put down. That one maybe, or was it this one? Yeah, that one. Maybe that one. That one and that one. There we go. So that was the June-July resistance, and we sort of come below that. This black line here is the pre-pandemic high. So the pre-pandemic high down here, obviously in February, March 2020 is what we got to, and with that, essentially, we have we're very close to that, have been. And so we need to kind of decide whether this is a relevant level or take it out altogether. If that level, which is just under 3,400, so just about the same level, if I just put it down to a weekly again, see our two levels there. That's the 3,400. So just below that is the pre-pandemic high. That means we could head lower below that pre-pandemic high, and that would take us to if I just kind of squeeze below there. Okay, so essentially, you know, the level below that would be this high, which is at 2,900. Now that's quite a lot to achieve. It's not to say that we're going to get there, but there's no reason why not. I mean, it's a fair game here, so any lower than that we can really just see. So this kind of gives an idea of where we're at. Just kind of going into next week, I'm just going to move myself there. So next week what we have is for the US, so I'm just going to scroll down to some interesting points. We've got of note for the US, we've got, well, clearly we've got some Chinese data. Inflation rate still very low, you know, compared to the West, so to speak. We've got USD data coming out. The one that's kind of considered a high of high importance really doesn't come until here, which is the 10th. That's Thursday next week, and that is the inflation rate, CPI inflation rate. You know, consensus 8, previous 8.2. Jobless claims, well, we've had a lot of that already, so not that relevant. But core inflation rate 6.6 was 6.5. Clearly that's a very important benchmark, but we had to wait almost a week for that, so we're just kind of really stuck. Now the US session hasn't started yet, so we are just kind of waiting for this to hit price and see how that influences the direction of the SPX, the Standard & Poor's 500. And so, you know, the new candle started. We had this very long wick. The previous hour is now expired, and again another wick, a tinge of red. You know, on the 4 hour, it's very clear that on the 4 hour, it's very clear that we sort of bounced off this low. We had the divergence, we came down. Price and the CCI basically together in sync. We're up to the 21 WMA, however, so it'll be interesting to see what happens if just below there, not being able to find strength. Now, if I go to my broker's platform, I've added a few indicators, and what we see here is the 100 and the 200 moving averages. So for the daily, where we are at is that we are below the 100. The 200 is far above. And if we go to the weekly, just again to kind of check on that, because it was something, a bit of a conversation that we had there. With the weekly, what we're doing is we're below the 100 and above the 200. Okay, so that's the 200 there, just so you know. So we are above the 200. We are, as I said, just coming off that middle level, which is the basis of the Bollinger Bands. But another thing that's of interest is these indicators here. Now, just while we're on the weekly, you can see that we've got quite a few things going on there. So the ATR, let's start with the ATR, still quite elevated. You know, clearly we had a dip during the summer rally. We started climbing higher again. This is the directional index. Strong direction here throughout all that, through the year essentially, the downtrend. And then we sort of plateaued. There's not been a lot of direction both ways. CCI we talked about. But the advanced decline as well, we had a slow kind of advance here, but not so strong. If we go to the daily, sort of see what the daily looks like. Essentially, we looked at the CCI already. The ATR, again, slightly deteriorating there, which usually suggests that we're going to go up. But we've not really sort of taken out this low here from the start of the week, or Tuesday rather. The ADX, again, for the strong decline, negative divergence really to price, and that means that it's not really a strong rally. So we have to see where we go. And the advanced decline again, a bit of an uptick, but again it's sort of following that curve there. And if we look at the 4 hour, just to kind of take it to a shorter time frame, again we've got the ATR there declining, slight uptick today. The advanced decline again not very strong here, and the ADX again trying to pick up some momentum. So kind of a mixed bag really across time frames. You get in different directions. So the weekly is very clearly bearish off that middle line, CCI as well, but you know, the VIX is saying another thing again. So now you can see the 4 hour there ticking up. If we take it down to an hour, currently it had this big move suddenly. You know, we not even got to the kind of officially the US Open. It's not until 2:30 as far as I understand. So, but it's the hour of the US Open, so there's a bit of interest there peaking, and then we'll see what happens with the CCI there on the 1 hour. We're basically back up to the top 200 there, and the last time we saw that was just before the Fed rate decision, and then we started seeing the collapse there where we had a rejection. So again, it's this kind of yo-yo at the moment. Big flash moves, congestion, lots of congestion, attempts to revive a trend to the upside, and more of the same really. So all I can tell you is keep an eye on things. Make sure that you know, you're kind of covered for sudden moves like this. And my interview with a trader that I can't reveal yet was meant to take part last night. Change of plans. It will take place on Monday night. So they'll take part in the interview on Monday night. So next week I will have that video for you instead of this usual kind of trading analysis. So I look forward to that. In the meantime, take care and good luck with the rest of the trading day. See you later.